Do you want to simplify your finances and build long-term wealth without juggling 14 different accounts and a spreadsheet to track every single dollar? Well, good news. You don't need to. You don't need to be perfect. You just need the right setup. In this video, I'll walk you through the 5 accounts you absolutely need and 2 more you really should consider if they apply to your financial priorities. Each one serves a clear purpose, and when you use them together, you get a financial system that's flexible, tax efficient, and built to last. I'm Greg Meyer, certified financial planner and CPA with over 18 years experience in tax and wealth management. I've helped hundreds of clients simplify their finances and make smarter decisions with their money. So let's get started with the 5 accounts that everyone should have. Number 1 is a checking account. This is your day-to-day account that you use to get paid and to pay your bills. Most people only really need one checking account. If you're self-employed, then you should have another separate account for the business, but one account for your personal spending. If you're married, each spouse can have their own personal account and then maybe a shared joint account, or some couples just share one account for everything. The structure is up to you. There's no tax benefits to a checking account. This is purely for cash flow purposes. You do get FDIC insurance of up to $250,000 in a checking account. Checking accounts typically pay little to no interest, so they're really not meant for holding large amounts of cash or long-term savings. Typically recommend about 1 to 2 months of living expenses is what you want to keep in a checking account at any time. The second account that you need is a high-yield savings account. Savings accounts pay a much higher rate of interest than checking accounts and are ideal for holding things like an emergency fund, which is typically 3 to 6 months of living expenses. They're also great for short-term savings goals like a vacation, car repairs, or even a down payment. Interest paid on a savings account is taxable as ordinary income, and there are no tax savings on contributions or tax penalties on withdrawals. Just like checking accounts, savings accounts also get FDIC insurance of up to $250,000 per account. Some savings accounts have limits on how many withdrawals you can have per month, but that's usually not an issue because you have a checking account that is going to be your transactionary account. High-yield savings accounts are great places to save for short-term goals because you don't have to worry about losing principal. They are not ideal for long-term savings, however, because interest you earn is unlikely to keep pace with inflation in the long run. The third account is a Roth IRA or a Roth 401k. Roth accounts are one of the most powerful tools for tax-free retirement. They provide tax-free growth and tax-free withdrawals in retirement. Roth accounts are available in both an IRA and a 401k format if your employer allows it within your 401k. Roths are great for younger savers or moderate earners in low to middle tax brackets, where the upfront tax deduction from a traditional pre-tax retirement account is just not as valuable. Contributions to a Roth are made on an after-tax basis, so no tax deduction when you make the contribution. However, the investment earnings grow tax-free, and all the withdrawals are tax-free after age 59 and a half. To make contributions to a Roth IRA, there is an income limit of $150,000 for a single. However, there may be the opportunity to do a backdoor Roth IRA contribution depending on your specific situation and if you have other pre-tax IRA accounts. Contribution limits to a Roth IRA are lower at $7,000 at 2025, whereas contributions to a Roth 401k have no income limits and higher contribution limits of $23,500 in 2025. The great thing about Roths is that you can always take out your principal contributions anytime, tax and penalty free. The amount that you put in, you're able to take out if you need it for any purpose. But withdrawals of earnings before age 59 and a half are subject to taxes and penalties. The fourth account is a pre-tax, or also known as a traditional IRA or 401k. For most people, the traditional retirement account is your main retirement vehicle. Many employers also offer matching contributions to their 401k plans, which further increase your savings ability. Contributions to a traditional 401k or IRA are made on a pre-tax basis, so you can reduce your taxable income in the year of the contribution. Withdrawals are taxed as ordinary income when they are withdrawn in retirement. Many people are in higher tax brackets during their working years than they will be in retirement, so it makes sense to get the tax deduction when your income is higher and you're in a higher tax bracket, and to opt to pay the tax when you are not working in retirement and in a lower tax bracket. Withdrawals before age 59 and a half are subject to a 10% penalty. Traditional IRAs and 401ks are also subject to RMDs, or required minimum distributions, which are essentially forced distributions out of the account at set ages. For most people, this will start at age 73. Contribution limits to a traditional 401k are the same as a Roth, $23,500 to a 401k in 2025 and $7,000 to an IRA in 2025. The fifth account is a taxable brokerage account. This is your flexible, taxable investing account. There are no income limits or contribution caps, and this account can be used from anything from early retirement, saving for future purchases, or just building wealth beyond your retirement accounts. A brokerage account is taxable on earnings that you earn in the current year. So dividends and interest from your investments are taxable in the current year. Realized capital gains are also taxed if you made a sale of an asset. Capital gains are either taxed at short-term or long-term capital gains. And long-term capital gains qualify for preferential tax rates of anywhere from 0 to 15 to 20%, depending on your tax bracket. You can do tax minimization strategies like tax loss harvesting to reduce your capital gains, but at the end of the day, they're not as efficient as retirement accounts. However, there are no restrictions on withdrawals, and you can use the funds for whatever you need. So the flexibility is a major selling point to having money in a brokerage account. Beyond the 5 core accounts, there are 2 additional account types that you should consider if they fit within your financial priorities. The first of which is a health savings account, or an HSA. This account is used in conjunction with a high deductible health plan and is the only triple tax exempt account. Contributions are made on a pre-tax basis, so you get a tax deduction on the contribution. The growth is tax-free, and all withdrawals are tax-free as long as they are used for qualified medical expenses. Money in an HSA can be used now to reimburse yourself for medical expenses you incur in the current year, or to further maximize the savings, you can invest the money for additional tax-free growth and reimburse yourself for medical expenses in retirement. They can even be medical expenses that you incur today, and you choose to save that money and invest it into retirement. Very flexible, very tax-efficient account. You do have to, however, pair it with a high deductible health insurance plan, meaning your deductible is going to be higher. You're going to have more out-of-pocket expenses in the current year. And the contribution limits for 2025 are $4,300 for an individual and $8,550 for a family. And the withdrawals do have to be used for qualified medical expenses, or they will be subject to a penalty. The last account is a 529 college savings account. This account is used to pay for education savings. Withdrawals can be used to pay for qualified education expenses. However, if you have more money in the 529 than you need for education expenses, there is the ability to roll over up to $35,000 into a Roth IRA for your child. There is no federal tax benefit on contributing to a 529, although some states offer deductions or credits on their contributions, but no federal deduction. The major benefit of 529 is once the money is in the 529, you can invest it and all that growth is tax-free, and all the withdrawals are tax-free as long as they are used for education purposes. Non-qualified education expense withdrawals are subject to income tax when you take that money out and a 10% penalty. So ideally, you really want to use it for education expenses for any money that's in there. Annual contributions are subject to the gift tax rules, currently $19,000 per person in 2025. If you want to super fund the account, you can do up to 5 years of gifting upfront. We've gone through the 5 accounts that you need to have and the 2 accounts that you may want to have based on your situation. But how should you start implementing this setup? First, start with your checking and your high yield savings account. This covers your cash flow and it covers your emergency savings. And this is the core building block of a solid financial plan. Then, look at your retirement. Depending on what your tax bracket is, you want to look at either the Roth or the traditional. If you're in a low tax bracket now, Roth makes a lot more sense. If you're in a higher tax bracket now, then usually traditional makes the most sense. But look at your specific situation and see how your tax rate now compares to what it will be in retirement. After that, savings can go into a brokerage account for the added flexibility of being able to use that money for whatever financial priority you have. Finally, add an HSA if you're eligible, and a 529 account if college or education savings is a priority. The red accounts don't just help you grow your wealth. They simplify your financial life, reduce taxes, and give you peace of mind. Start with the 5 essentials and then add the HSA and the 529 if they make sense for your goals. Please like and subscribe for more tax-smart personal financial tips, and comment below with how many of these accounts you already have.